Good evening, I'm John Batchelor. This is the John Batchelor Show. Gordon Chang, Forbes.com contributor, is here with me, and we are watching a phenomenon of markets. It's happened before, several times in the last several hundred years. It's called a bubble. Bubbles are a way of expressing human ambition. That you watch a story take hold of a civilization. Once upon a time, Gordon, the South Sea bubble, the land was going to be developed for all of the investors in Europe. That was the 18th century, and they bought the story. Then there was the tulip bubble. They bought the story. And in the United States, we've had bubbles repeatedly, panics, declines through the last 200 years. It's part of capitalism. You allow people to spend their money, all kinds of nonsense. You just stand back and let it. There's a winner and there's a loser, and we recover. So it's not the end of the world, correct?
Sure. I mean, humanity has gone on.
Right. And there's a bubble now in China, and we can be philosophical about it, and the Chinese will moan and gnash and play the bad rice game of praying to the gods that we can get just one more day of a bubble. They know it's a bubble.
Well, they certainly do, because it's gone beyond the fundamentals. It's untethered to the Chinese economy or Chinese stocks.
We're talking bubble now with Fraser Howie, the co-author of Red Capitalism. Fraser is in Asia, and a very good morning to you. Since we've started talking, I'm sure the Shanghai market is up at least 1%, Fraser. This is a phenomenon that I recall personally participating in the NASDAQ market of the late 20th century right up till March of 2000, when it went through 5,000, and everybody said, trees grow to heaven, it will go higher. It did not happen. And when the crash, which started in March of 2000, took hold, the NASDAQ market went all the way down through from the 5,000 number on the index to below 2,000 in the depths of the early part of the 21st century. It's now recovered, but it's 15 years later. Does that sound like the sort of cycle we're witnessing in Shanghai right now? Good morning to you.
Good evening to you, gentlemen. It's a cycle we've already seen in China. Back in 2007, we saw a similar scenario where the index went from 1,000 points to 6,000 in about 2 years, and then literally 2 years later it was back at under 2,000 points. And so China, I always say, never has bull markets, merely has bubble markets, and this is just a phenomenal bubble market. We have liquidity. We have $300 billion of stock trading on any given day in China at the moment. The numbers are just phenomenal.
So, Fraser, despite the Chinese market going in one direction only, which is up, MSCI, the compiler of stock indices, did not include the Chinese A-share market, in other words, domestic shares, in its emerging market index. And they made this decision about 12 hours ago. This means that foreign companies and foreign stock funds are not going to be putting, let's say, $20 or so billion into the Chinese stock market. But is the failure of MSCI to include China, is that going to stop the market surge in China itself?
No, I don't think so. Ultimately, the MSCI was a regular review of whether they include China or they do not, and I think they made the right decision. China has opened up a lot in the past few years, but there's still some work to do, and MSCI did a very sensible presentation and raised these concerns and says they're not there yet. But frankly, no one was buying this because of the MSCI decision, and certainly there's some money that's not going to come in from the foreigners, which is forced to go in because they track the index. This is a domestic story. China is always a domestic story because there is so much liquidity, there's so much money being printed in China at the moment. There's so many people chasing the market. And why wouldn't you chase it if you're going up 1%, 2%, 3% a day for a week, 2 weeks, 3 weeks, 4 weeks, 5 weeks? You've got Shenzhen up over 111% this year. This is a domestic story, and there's plenty capital in China, and they've had nothing to invest in. Properties going down, the stock market's in play. That's where the money's heading.
You told me what the multiple is of the index,
The Shenzhen index, which tracks the small caps and a lot of the private companies, the PE ratio is 130 times.
And 30 is way too high for reason, and this is 130.
This is 130 times, but it keeps going up. This is the thing. It's if you buy at 10 and sell at 20, you make $10, regardless of whether it's got any value at all.
So, Fraser, if you look at the Singapore stocks, for instance, what is they trading at these days?
Oh, I don't follow Singapore, believe it. Although I sit here, I don't follow them that closely. But we've gone beyond any sort of comparative measures. This is the point, that there's no, you can't say 130 is just too expensive at any level.
Yeah, basically, you look at stocks and the most you get is like 10 or 20 and maybe even 30. But that is just, what they've done in China right now is just enormous. Oh,
I've just been at a chance to look. Singapore's trading around about, in Singapore index, the broad index is trading roughly at 15 times.
Okay. So that's a good comparison.
That's acceptable.
Yeah.
15 times, that sounds like a buy, actually, compared to 130. Now, connect this to the sagging economy. Is it linked, Fraser, your opinion?
Well, it is linked, of course, but it's linked in all the wrong ways. It's linked because the sagging economy, which continues to sag, let's not be fooled by that, it continues to sag. But what that has meant is that the government has had to orchestrate either bailout or some form of stimulus, fiscal or monetary stimulus, i.e. pour more money into the economy, and that money is heading to the stock market. So there's no connection in the sense of there's underlying strength in the economy, which is driving the stocks, but what's happening is it's weakness in the economy that's driving liquidity from the government, which is driving the stocks. So they are linked in that sense. So it really is bad news is good news for the stock market. Although there is a sort of, I don't know if it's a silver lining of sorts, but what this rally has done is it's taken some pressure off the debt problem in China, because what it has allowed many companies to do, instead of tapping shadow financing, although that's still very active, they are able to raise funds in the stock market which they no longer need to pay back. And so that's a lot of funds that companies needed which were going to be raised on debt and now being raised in equity, which they don't need to pay back. So that takes the pressure off some of the debt issues we've seen in China.
If I recall correctly, though, the bubble of NASDAQ 2000, I haven't paid attention much since. The reason that the deceleration was so violent is because it was borrowed money. I think they called it trading on the margin. Is that true in China as well?
That is true in China as well, and this is, I think, where we're very much in uncharted territory in China. Back in 2007, where we had a huge bull market in China, there was basically no margin trading. Now, margin trading is in excess of, I think, is it $300 billion or so? Now, that's up from, in the past 2 years, that's up tenfold. So you've got $300 billion of stock bought on margin, and this is what you've seen in the economy in China. Things that used to be fully funded are now funded on credit or by debt, and you've seen this just explosion of debt into all aspects of the Chinese economy, and that's what's very worrying, because I think even when people acknowledged there were problems before, there was a feeling there wasn't a lot of leverage in the system. Now, of course, there's a tremendous amount of leverage in all sorts of places.
So they're living on the margin, Gordon. That's the sort of thing that destroyed our economy in 1933, 1931.
Yeah, and certainly you've got a lot of brokerages that are exposed, and essentially the banks eventually are exposed as well. And, markets on margin move very quickly in both directions. And when they change direction, usually the small investors get wiped out because they're not in a position to be able to unload their shares in time.
But this is the same as the ghost cities, right? There's no other place to put the money, so they buy apartments in cities that don't exist.
Well, in some ways that is true, because you have an economy which, as Fraser talks about, cannot absorb government stimulus. So it goes into creating asset bubbles. And you had a property bubble because you had basically liquidity going into places where it couldn't go into the economy, so it went into property. Now it's going into the stock market. And in that way, they are linked.
Fraser, the government in Beijing can see this. Do they have a plan to get out of this when the bubble bursts?
No, I don't think they have any plan. I think that China's government, I think, is one of short-term thinking. I don't think there's any plan to get out of the bubble. They're just hoping the bubble doesn't burst. Or they're maybe even more foolish that they think they can control a collapsing bubble, which of course you can't. They're playing a very dangerous game because, as Gordon says, markets are volatile. And falling markets are much more vicious than rising markets. And so you don't know how this is going to play out. Although I think the government's hope is that this continues for, some period of time. But then, of course, if you're not getting these sorts of returns in the stock market, people will say, well, I'm taking my money out now. I'm only in the stock market because I'm getting a return. I'm not looking for a nice, steady 5%, 10% a year. If people aren't getting these excessive returns, then the money comes out. If the money comes out, the market starts to fall. It feeds on itself because of the leverage aspect, and you can have a very nasty ending.
The proverb I remember from the days I paid attention to the market was that you cannot catch a falling knife. When it starts to fall, there is no entry point. You just you panic.
That's right. And essentially that shows the desperation of the Chinese central government, that their only economic plan these days is to create a bubble and to try and keep it going.
And Fraser, just the last thought, it does not appear from the reporting we've heard tonight that foreign money's coming in, that the big funds in the West are investing in the Shanghai.
Well, they're not going to be forced to invest, but many foreigners are already in there. They do have access. They have made money out of it, but there's not going to be an extra kicker. But this remains still a domestic story. It remains a domestic story, and how it plays out is very much going to affect the local Chinese more than any.
Fraser, Howie, co-author of Red Capitalism, Gordon Chang, Forbes.com contributor. I'm John Batchelor.